Hello everyone, John AG here. Welcome back to my channel, Aurex. If you haven't yet, subscribe to my channel. In this channel, you will find the real information, real market updates that everyone cannot tell you. So please, subscribe to this channel, and I love all of my subscribers for your support. And please, watch this video till the very end, because YouTube will not push my videos to more people, and we have to add many things related to this topic today. I need you to stay with me, because what we are about to uncover will directly impact your family, your savings, and your survival in the decade ahead. Let us set the stage and rewind the clock just a few short months to January 2026. We witnessed a financial spectacle that historians will dissect for centuries. We saw the price of gold absolutely shatter every model, every projection, and every ceiling Wall Street had built for it. It surged past $5,000 an ounce, peaking near a staggering, breathtaking $5,589. I want you to remember how that felt. Do you remember the panic in the air? The United States and Iran had escalated into direct kinetic conflict. The Strait of Hormuz, the vital, irreplaceable global artery where 20% of the world's oil supply flows every single day, was effectively choked off. The energy shock was not a slow burn. It was immediate, violent, and utterly unforgiving. In that moment of sheer, unadulterated geopolitical terror, the entire world did exactly what the financial textbooks have dictated for 100 years. They bought gold. Central banks bought it. Multi-billion-dollar hedge funds bought it. And retail investors, ordinary people, terrified of what the morning headlines would bring to their pension funds, liquidated whatever they could to buy gold bars, coins, and paper contracts. It was a stampede. Gold was up more than 30% in a single month, a parabolic rise that defied gravity. And then, the trap was sprung. Instead of continuing its ascent towards $6,000 or $7,000 as the conflict dragged on and the supply chains withered, gold violently reversed course. It suffered its biggest weekly drop in 15 years. It plummeted from that euphoric peak down to the $4,500 range we are seeing right now in mid-May. That is a brutal, relentless 16 to 20% decline, wiping out billions of dollars in wealth from the hands of everyday people who bought at the absolute top, driven by pure, unadulterated fear. So I ask you, what happened? Why did the oldest, most trusted safe haven asset in human history bleed out precisely when the world felt the least safe? If you turn on the mainstream financial news networks today, you will see a parade of analysts in expensive suits telling you that the market simply priced in the war. They will tell you that profit-taking was the primary driver, that investors are just rebalancing their portfolios. They feed you these sterile corporate answers because they are terrified of what happens if you understand the underlying mechanics of the global liquidity trap we are currently in. They do not want you to see the true fragility of the sovereign debt system. But what if I told you that the very mechanism designed to save the global economy is exactly what is suffocating it? To understand the real reason gold is falling, you must first master the paradox of inflation in 2026. For your entire life, you have been taught that gold is an inflation hedge. And over a long enough timeline, spanning decades and centuries, it absolutely is. When fiat currencies lose their purchasing power, gold historically revalues itself to protect your wealth. But here is the brutal secret Wall Street uses against you. In the short term, markets are not driven by rational, long-term historical logic. They are driven by the vicious, unforgiving, algorithmic mechanics of bond yields and central bank panic. When the Strait of Hormuz closed in January, oil prices didn't just rise, they went vertical. This immediate energy shock sent a tidal wave of inflation crashing across the globe. We saw United States Producer Price Index numbers shatter even the most pessimistic estimates. April's wholesale inflation hit 6% annually, a terrifying number that means the core cost to manufacture, transport, and sell virtually anything on this planet went through the roof. Now, I want you to follow the institutional logic. When inflation surges this violently, what does the Federal Reserve do? What do the European Central Bank and the Bank of England do? They panic. All the desperate hopes that retail investors had for interest rate cuts in 2026, the cuts that were supposed to save the housing market and bail out zombie corporations, completely evaporated. In fact, the market algorithms instantly began pricing in the very real, terrifying possibility of aggressive rate hikes by next January. This, my friends, is the guillotine that came down on gold. When inflation expectations rise in this debt-soaked system, bond yields soar. Institutional investors look at United States treasuries, which the world still tragically considers the ultimate risk-free asset, and they see yields climbing higher and higher to compensate for that roaring inflation. At the exact same time, this dynamic creates a monster, a violently strong US dollar. A hawkish Federal Reserve, forced into a corner by energy inflation, makes the dollar act like a giant vacuum cleaner, sucking foreign capital out of emerging markets and into American debt. Here is the brutal mathematical reality for gold in a high-yield environment. Gold pays no yield. It does not pay a quarterly dividend. It does not wire a monthly interest check into your brokerage account. So, when the US Treasury is suddenly offering massive guaranteed yields to institutions, and the US dollar is acting like a wrecking ball against the yen, the euro, and the pound, institutional capital ruthlessly abandons gold. They do not care about the history of money. They do not care about the Roman Empire or the Weimar Republic. They care about this quarter's yield. They rotate out of the non-yielding yellow metal and pour trillions into high-yielding bonds and the surging greenback. It feels completely counterintuitive, doesn't it? It feels like madness. You buy gold because you are terrified of inflation destroying your savings. But the central bank's panicked reaction to that exact same inflation creates a macroeconomic environment that temporarily crushes gold's price. This is the tragic difference between emotional investing and understanding structural market plumbing. The big players, the high-frequency trading algorithms, the institutional whales, they trade on yield differentials and currency strength, not on the fear of World War III. But the strong dollar and surging bond yields are only half of the story. The other half is much darker, much more dangerous, and it reveals the sheer unimaginable amount of debt and leverage that is currently propping up the illusion of the Western financial system. Imagine you are standing inside a burning building. You are holding a priceless painting, but the only way out is a door that requires a massive cash toll. What do? You sell the painting for whatever cash you can get instantly, just to survive the fire. This is exactly what happened to the hedge funds in the spring of 2026. When the global stock markets started to crack under the immense pressure of war, supply chain collapses, and soaring energy costs, institutional portfolios began to bleed profusely. We are talking about massive hedge funds, family offices, and proprietary trading desks that use extreme, reckless leverage to maximize their returns in a 0% interest rate world that no longer exists. When equity markets dropped, these institutions faced a phenomenon that strikes primal terror into the heart of every Wall Street trader: the margin call. A margin call is a ruthless demand from your prime broker to add more cash to your account immediately to cover the losses on your leveraged, borrowed positions. If you do not have the cash, the broker does not care. They will liquidate your account by force. And in a global liquidity crisis, a margin call environment, you do not sell what you want to sell. You sell what you can sell. Gold is one of the most liquid, easily traded assets on planet Earth. It trades 24 hours a day, moving billions of dollars seamlessly. When hedge funds saw their highly leveraged stock portfolios, their speculative tech trades, and their risky junk bond positions collapsing, they were hit with margin calls so massive they threatened to bankrupt them overnight. To raise cash immediately, to put out the fire in their portfolios, they had to liquidate their absolute best performing asset. They had to shoot their winners to feed their losers. And what was their biggest, most profitable winner in January and February of 2026? It was gold. They dumped paper gold, futures contracts, options, and exchange-traded funds by the absolute billions. It was a fire sale of epic proportions. This was not a fundamental rejection of gold's inherent historical value. It was a desperate, panicked, forced liquidation to save their over-leveraged paper empires from total annihilation. We saw this exact same terrifying phenomenon during the 2008 Great Financial Crisis, when gold initially crashed before rocketing to new highs. And we saw it again during the 2020 pandemic crash. In the initial violent phase of a true liquidity shock, everything goes down. Everything. Because US dollar cash becomes the only oxygen left in a suffocating room. This margin call massacre artificially and aggressively drove the price of gold down faster and harder than any natural organic market cycle would ever dictate. The paper market, the derivative illusion of gold, completely and utterly disconnected from the physical reality of gold. And that physical reality is where the true story of wealth in the 21st century is being written. Let us elevate our perspective for a moment. Let us pull back from the minute-by-minute charts and look at the grand geopolitical chessboard. Right now, in May 2026, the entire world is holding its breath, watching the high-stakes diplomatic dance between the United States and China. The profound lack of a breakthrough in Beijing to resolve the Middle East conflict has kept the global physical markets in a state of suspended animation. The Pentagon is desperately scrambling to secure rare earth supply chains. Massive mining operations in South America and Africa are being halted globally due to severe water shortages, labor strikes, and creeping resource nationalism. We are witnessing the real-time, irreversible fragmentation of the globalized economy right before our very eyes. The mainstream narrative wants you to believe that peace talks will magically restore the old order, that a signed piece of paper will bring back the cheap energy and cheap goods of the 2010s. But if you look closely at the data, you realize that the foundation of the post-World War II financial system has already fractured beyond repair. The trust between the global East and the global West is broken. De-dollarization is no longer a fringe internet theory discussed in dark corners of the web. It is the stated, aggressively pursued macroeconomic policy objective of the BRICS nations. When the media sits there and tells you that gold is falling because of diminishing geopolitical risks, they are actively lying to your face. The risks have not diminished. They have simply morphed from an acute, television-friendly panic into a chronic, systemic, flesh-eating financial disease. The world is structurally broken, and no single summit between world leaders is going to fix the underlying commodity deficits, the raging inflationary pressures, or the historic, unpayable sovereign debt burdens that are crushing Western economies. This brings us to the absolute most vital concept you must internalize if you want to survive the financial hurricane of the decade ahead: the absolute, total divergence between paper gold and physical gold. When we look at our screens and see the spot price falling to $4,500, we are looking at a phantom. We are looking at the paper market. We are looking at Wall Street trading algorithms and high-frequency computers exchanging billions of digital contracts backed by nothing but fractional reserve leverage. But what is happening in the real world? What is happening when you demand delivery of a heavy, physical bar of gold? I want you to look at the data quietly released by the World Gold Council for the first quarter of 2026. While the paper price was violently correcting, while the media was declaring the gold bull market dead, physical demand for bars and coins reached 474 tons, the second highest quarterly total ever recorded in human history. It was up 42% year on year. And who exactly is buying? Is it just retail investors, the mom and pop savers trying to protect their retirement? No, it is the central banks. Central banks bought an astonishing 244 tons of gold on a net basis in the first quarter of 2026 alone. Think about the profound hypocrisy of this for a second. Even when gold was averaging a record $4,800 an ounce, the central banks, the very same institutions that print the fiat currency out of thin air, the very institutions that tell you inflation is transitory, were quietly, aggressively trading their own worthless paper for physical gold bullion. They are not trading on margin. They are not worried about next week's options expiry or beating quarterly earnings estimates. They are executing a long-term, calculated, structural shift in global reserve management. They know the truth. They know that the current fiat debt system, burdened by impossible mountains of sovereign debt that can never be paid back through taxation, is mathematically destined to devalue. They know that you cannot print an oil well, you cannot print a wheat field, and you cannot print your way out of a physical commodity shortage. If the absolute most powerful financial entities on the planet, the entities that control the global money supply, are buying physical gold relentlessly, regardless of the paper price fluctuations, what does that tell you? It tells you that this current pullback is not a reversal of the fundamental trend. It is a tactical, engineered shakeout. It is a massive, historic transfer of wealth from impatient, over-leveraged, emotional speculators into the strong, unyielding hands of sovereign nations and generational wealth preservers. But I want to step away from the macroeconomic data, the institutional flows, and the geopolitical posturing for a moment. I want to talk about the human element. Because at the end of the day, economics is not about numbers on a screen. It is about human life. It is about you, me, and the future we are trying to build for our families. Why do we even care about the price of gold or the mechanics of inflation? We care because money represents our time, our energy, and our literal life force. When you wake up before dawn, when you work 40, 50, or 60 hours a week, you are trading your finite, irreplaceable time on this earth for currency. You are storing your labor in a medium of exchange. When governments inflate the money supply, when they print trillions of dollars to fund endless foreign wars, to bail out corrupt banking institutions, and to finance unpayable promises, they are quite literally stealing your time. They are reaching their invisible hands into your savings account, your pension, and your children's college fund, and they are diluting your life force. You feel it. You feel it deeply. Every single time you walk into a grocery store in 2026. You feel it when you pay your utility bills, which have doubled in the last 3 years. You feel it when you look at the price of a modest family home and realize that the goalpost hasn't just been moved, it has been ripped out of the ground and placed in another dimension. This isn't just dry economics. It is a deeply, profoundly moral issue. Inflation is the most vicious, regressive tax on the planet, mathematically designed to punish the working class, the savers, and the poor, while effortlessly enriching the asset-holding elite who own the equities and the real estate. Gold is not just a shiny yellow rock. It is a mirror. It is a mirror reflecting the spectacular failure of fiat currencies and the arrogance of central planners. It is the ultimate measure of trust, or rather, the absolute lack thereof, in the promises of politicians and central bankers. When you see gold pull back from $5,500 to $4,500, it is incredibly easy to feel demoralized. It is easy to feel defeated, to think that the system has won again, that the central banks and the bullion banks have successfully manipulated the market to crush the only honest safe haven left. But I need you to understand that true, multi-generational wealth preservation is not measured in days, weeks, or even quarters. It is measured in purchasing power over decades. An ounce of gold bought a fine, tailored suit of clothes 100 years ago in the roaring 20s. Today, in the chaotic world of 2026, an ounce of gold still buys a fine, tailored suit of clothes. A $100 bill from a century ago, however, has lost over 98% of its purchasing power. It is a melting block of ice in your hands. And while we focus so intensely on gold as the ultimate monetary anchor, we would be completely blind to ignore its more volatile, explosive counterpart, silver. Just yesterday, on May 14th, silver tumbled incredibly hard, dropping a violent 6% on the MCX and nearly $4 an ounce in the international spot market. It fell roughly 10 times harder and faster than gold. Why? Because silver is the most misunderstood asset on the board. It possesses a schizophrenic dual identity. It is a monetary metal, a historical form of money, yes, but it is also a highly critical, irreplaceable industrial commodity. Over half of all the silver mined on planet Earth today is completely consumed by industry. It goes into the solar panels powering the green transition, the electric vehicles mandated by governments, the microchips running our artificial intelligence, and the vital medical technology in our hospitals. When the inflation shock hit this week, and the market violently realized interest rates were staying high to fight it, it dealt a massive psychological blow to global industrial growth expectations. Higher interest rates mean more expensive capital, which means slower factory output, delayed green energy projects, and a cooling economy. Therefore, the massive industrial premium embedded in silver's price evaporated in a single, brutal afternoon of trading. But here is the deeply concealed secret that the mainstream financial press absolutely ignores. The world is currently in its 6th consecutive year of a massive, structural silver supply deficit. We are literally consuming, destroying, and burying more silver than we are physically pulling out of the ground. By current 2026 estimates, we are staring down the barrel of a 46.3 million ounce physical shortfall. You cannot print silver out of thin air to build a solar panel. You cannot use a high-frequency trading algorithm to manifest a physical supply deficit out of existence. The industrial machine of the 21st century requires physical silver, and the vaults are quietly draining. What we are witnessing right now with both gold and silver is a painful, brutal, but mathematically necessary cleansing phase. The weak hands, the tourists, the emotional speculators who bought blindly in January simply because they saw the price going up on their social media feeds are being ruthlessly washed out of the market. The leverage is being purged from the system. If you look past the noise, you will see that analysts at major institutions, despite their bearish, sensationalized, short-term tones on television, still quietly forecast gold pushing back toward that $5,000 mark by year-end, and potentially much, much higher as we move into 2027. The World Bank itself is projecting precious metals to surge 42% on average this year due to supply constraints and currency debasement. The absolute, undeniable macroeconomic fundamentals have not changed one single bit. Only the temporary, fleeting sentiment has. The real reason gold is falling is not because the world has suddenly become a safe, stable, utopian society. It is not because the beast of inflation has been miraculously slain by the Federal Reserve, and it is certainly not because the deeply flawed, debt-based fiat currency system has been mathematically fixed. Gold is falling because of a lethal, short-term cocktail of forced institutional margin liquidations, widespread panic over a hawkish, trapped Federal Reserve, a temporary, engineered surge in the US dollar, and the mechanical, emotionless trading algorithms of a completely broken paper derivatives market. But the physical reality on the ground remains exactly the same as it was the day gold hit its all-time high. The global sovereign debt sits at an astronomical, civilization-threatening high. The geopolitical alliances that have maintained peace for the last 80 years are tearing at the seams. And the slow, methodical, unrelenting accumulation of real, physical, tangible assets by the world's most powerful central banks and sovereign wealth funds continues unabated behind the curtain. As an investor, as a sovereign individual, as the protector of your family's financial future, you must develop the psychological fortitude to recognize the profound difference between price and value. Price is merely what the flashing red screen tells you right now, driven by leverage, fear, forced liquidations, and algorithmic noise. Value is the undeniable, historical, mathematical truth that physical commodities, sound money, and tangible assets will absolutely always outlast the unbacked paper promises of bankrupt, indebted empires. Do not let the short-term manipulation of paper markets shake you out of your long-term, fundamental convictions. Use these manufactured pullbacks, these moments of maximum market pessimism, as a time to aggressively educate yourself, to deeply understand the true macroeconomic forces at play, and to position your portfolio not for what might happen next week, but for the monumental wealth transfer of the next decade. This exact dynamic, this very gap between truth and manipulation, is why I started Aurex. To cut through the endless noise, to give you the unvarnished, sometimes terrifying truth when the corporate financial media is actively trying to pacify you with pre-approved talking points. We are living through the pages of financial history right now, and the critical decisions you make in these exact moments of artificial market corrections will define your family's financial legacy for generations to come. I want to hear from every single one of you. What are you seeing in your local economies? Are you feeling the inflation at the ground level? Are you using this exact moment to buy the dip and accumulate real assets, or are you waiting for the dust to settle? Drop your thoughts, your strategies, and your observations in the comments below. We have built a community of critical thinkers here, an alliance of people who refuse to be lied to, and your insights are incredibly invaluable to all of us. If this video opened your eyes, if it gave you the clarity and the historical perspective that you simply cannot find on cable news, please smash that like button right now. Share this video with your friends, your family, your colleagues, and absolutely anyone who desperately needs to hear the truth about what is actually happening in the shadows of the global financial markets. Once again, thank you for watching, for giving me your time, and for your incredible continued support. John A.G. signing off. Stay vigilant, stay fiercely educated, and I will see you in the next one.